Hi there, this is Andy Brown, one of the owners of the ClimerSchool of Real Estate, the best real estate school in Florida. I'm going to be making another real estate math tutorial video for you. Hopefully it will help you on your state exam when you're at Pearson VUE. This one is on prorations, specifically the annual real estate tax prorations. It comes up a lot, and I can almost guarantee you're going to get one of these on your state exam. Now, keep in mind, I'm not trying to make you a proration expert. That is the title company's job. But we want to make sure that you get the answer right at Pearson VUE. Now, to do any proration, you have to know three things. What is the actual bill? What is the day of closing? And something called who is the day of closing being charged to. I'm going to use an example that is especially going to help my online course friends. All right, so in this example, the annual tax bill is $3,467.50 per year. You got to capture the unit, month or year. The closing date is July 23rd, and the day of closing is being assigned to the buyer. Now, for any proration, the first thing you have to do, I don't care who you are, how much is each day worth in that period? In this case, we have a year. We're going to divide by 365. All right. In your little calculator, 3467.50 divided by 365 is about $9.50. So what that means is every day is worth $9.50 in real estate taxes. Now, the question is, who owes who what? Here's the real deal with prorations. The tax bill does not come out until November the 1st. That's just a fact of life. You can pay it a couple months early, but you cannot pay it earlier than November the 1st. But we're closing on July 23rd. Now, the seller was the happy homeowner from January 1st to the day of closing. They owe for those days of taxes. The bill's not coming out until what, about 3.5 months after closing, when the buyer is now the new homeowner. They rightfully should pay the days of taxes in that year from the day of closing to the end of the year. And if they call the seller in November and say, hey, I need some money from you, I think what they're going to hear is a click. So the title company takes that money ahead of time from the seller for those days, slides them across the table, and gives the money to the buyer. So now the question is, how many days did the seller own the house? I apologize, but you do need to know the days in the month. I like the knuckle bump method. So there are 31 days in January. February is 28. March is 31. April is 30. May is 31. June is 30, but oh my goodness, we have a problem because we're closing in the middle of July. So you got to do the same thing. Now there's 31 days in July. I'm going to draw a quick picture for you. The seller owned the home from July 1st to July 23rd. And the buyer owned the home from the day of closing to the end of the month. The problem says the day of closing belongs to the buyer. So that means the buyer gets day 23. Which means the seller is 1 to 22. That means in July, the seller is only responsible for 22 days worth of taxes. Beautiful. If I add those together, that's 203 days. All right. We just said every day is $9.50 in taxes. If I multiply those together, I believe I get $1,928.50. I don't have my glasses on, so I'm hoping that's true. That is the prorated dollar amount. It's going to be the same for the buyer and seller, but you're not done yet. Who is giving and who is getting? So I want to remind you, the buyer is going to be getting that money because they need it to pay the taxes at the end of the year. The seller is paying that money because they're giving it to the buyer. So how does that show on the closing disclosure? That shows as a happy face credit to the buyer and a frowny face debit to the seller. And congratulations, you have just prorated those taxes. I hope that helps. Have any questions? You can email the school, any of the instructors. Good luck at Pearson View, and above all, don't overthink it.